Welcome to the Global Investor Podcast, a show that focuses on helping foreign investors enter the lucrative U.S. real estate market. Host Charles Carillo combines decades of real estate investing experience with a professional background in international banking to interview experts in all areas of U.S. real estate investing. Now, here's your host, Charles Carillo.
Welcome to another episode of the Global Investors Podcast. I'm your host, Charles Carillo. Today we have Randy Langenderfer. Randy is a passive investor on over 4,000 apartment units and a general partner on over 250 units. He's been a private money lender in the single family space and has over 30 years of experience in the corporate leadership. So thank you so much for being on the show, Randy, and hopefully you can correct my pronunciation of your last name.
Charles, you did great. It's a pleasure to be here this morning and look forward to hopefully adding some value to your listeners.
Awesome. So can you tell us a little bit about your professional background prior to starting your current investment business?
Yeah, so I took the pretty classic road, of going to college, getting a degree, joining a big company. That was the way my father worked for his career, working for a big company, and encouraged me to get a good education and a good job, of which I'm thankful for. I'm still in the corporate world today, but I've had the pleasure of serving in several different industries, and my expertise is really in I'm educated in finance, accounting, and information systems, and my work experience is in the last many years has been around corporate governance areas such as IT security, compliance, privacy matters, as well as internal audit. And I'm currently at a large academic medical institution in the Houston, Texas market.
Okay, great. And then why did you choose real estate as your investment vehicle coming from the corporate world?
So my journey began probably about 10, 12 years ago. I was working for a private equity company at the time, a global manufacturing private equity company. And if you know anything about those guys, their turns are 5-7 years max, just like a syndication. Rather than we do it with apartments, they do it with companies. Excuse me. And I had come to the conclusion that my time with this company was coming to a close in the next 12 months or so, because it was going to be sold. And, though I'm astute, I guess, as a finance MBA and a CPA, but it takes that real life experience to hit it home to say, you need to do something different. And so I started to, I got attracted to real estate by a brother-in-law at the time who had been a displaced exec. And he came to me and he had gone to Armando Montelegro's. He's a flipper that you may see in the late night infomercials. He had a school out in California, and he went there and paid big money. And he asked me to join him on flipping houses in South Florida. I said, you're stinking nuts. And then he also said, well, really, if you want to do this, you need to develop a self-directed IRA, more funding. And I said, you're double nuts at this time. Because as a finance guy, traditionally we're risk adverse at heart. So that's where it started in the single family flipping spaces, and realized that I needed to have another income. And so this is developing a second income stream, and something that as I move out of the corporate world one day, I really don't want to quit. I want to continue on and just change directions. So,
okay. So all the different kind of parts of real estate that you've been involved with, you lent millions of dollars as a private lender for single family flips. You're currently a passive investor in over 4,000 doors, which is probably one of the most for any person I've spoken to personally as a passive investor. And you've also become an active investor with over 250 units. So how does that help you coming from that passive side? And I would imagine, lending on single family homes as a private lender, that's kind of a semi-passive side, I would say. But how has that prepared you for becoming an active investor?
I think what Charles would help me do overall is I think it helped me refine or define what I really wanted to do. There's so many aspects as you come into the real estate world, what you could do. Single family, multifamily, storage, mobile home parks, buy and hold strategies, flip strategies in each. And so I started out in single family because that's where I had a mentor, a brother-in-law, as I mentioned. And I learned that I was living in the Ohio area at the time, and I relocated to Houston for business purposes when that private equity firm was ending. And I realized just how much work it was to keep flipping and to get turns and to get leverage, scale, that you had to do a lot of work gaining comfort with the person doing the work, the comps in the area, the rehab plan, all that stuff became very detail oriented. And so when I attended a single family session here, one of the big educational sessions in Houston, I really got turned on to multifamily. And so my transition was, one, learning the many different things out there, two, what I didn't want to do, and then defining that multifamily was the area that really interested me, I guess, first of all. And the last two I would mention is I became enthralled with the thought of non-recourse debt. I had looked at buying businesses along the way, but was very reluctant to sign personal guarantees. So the thought of syndication, not having to have millions of dollars, which I didn't, or have to sign personally and put everything I had gotten so far in life, any assets I had accumulated, my house, my cars, everything else, I just didn't want to sign for those. So I think that start was very good. And, everybody needs to find out what's their comfort zone and what's in it for them, because we're all different.
Yeah, I feel it's a great starting point for new investors. What about for you? Is that something that you suggest to people when they're interested in starting, but maybe don't have the expertise?
I don't have the expertise, and the reality is they may not have the capital either.
Yeah.
I mean, let's face it, multifamily is a capital intensive game. It's not a no money down, no, bad credit and all the stuff you see advertised. So
Carlton Sheets type program.
Carlton Sheets, there you go. He was the forerunner to Armando Montalego. But yeah, I think it's a great place to start. And I think the ability to work with people of like-minded there to get houses and to flip if you want to, because the fastest way to create cash, quite honestly, of what I've learned, is flipping houses. There's risk involved. You have to educate yourself and find those. But the fastest way to make cash is to flip houses. Multifamily is a long-term strategy, 3, 5, 7 years at a minimum generally. Buy and hold houses, you can do that. But if you want to generate some quick cash, single family flips is a good place to start.
Yeah. And the other thing about that too is that with single family flips, one thing that kind of I did years ago, and when I was active managing my real estate, because you had a lot more access to a lot of contractors regularly, so it was much easier to complete that. And I found that to be the hardest part of flipping. The other thing too is that when you're flipping, it has to be to the FHA specifications. So it's very difficult to take a house that's in terrible shape and make sure it fits all these different buckets, right? That are put out by us, so they can get financing when you sell it. When you're doing with multifamily, it's a much longer term play, and you'll know that when you go to one of these conferences, whether the difference between the level of wealth of people that you meet at a multifamily or self-storage conference plus compared to a wholesaling or flipping conference, everybody's in a completely different financial position, which is interesting too, because they've already realized this is a 5-10 year investment scenario, right? I'm not just trying to get my car from not being repoed next week. And it's like different. And it's like when we go into multifamily, you can go into a property and say, oh, we'll spend $5,000 to renovate this, or we can just $500 to paint it and to clean it, and we'll rent it again. It doesn't have to fit any specific kind of checklist, right? That we need to prepare it for the next person. It's depending more of our decision of where we want to put that unit. So.
Yeah. And so for the novice can become overwhelmed pretty quick with those options. I guess the thought I'd leave with your audience, if any of them are in that category, is just to get started. Pick a place and start, because the analysis paralysis is so easy to fall into.
Yeah. And there's so many different ways at how that pushes you back when you're looking at properties. And there's so many things you're supposed to be reviewing before taking action. But that also, like you said, can really elongate the time before you actually purchase a property. So, Randy, when we were talking previously, you're talking about one of your investments, and I believe it was like your first or second deal as an active investor, a general partner, and you had some serious issues with that property. Can you tell us a little bit about that deal and what happened with it?
We've all had those experiences in life where you look back and say, that was very beneficial, but when you're living through it, it's extremely painful. Yeah. And that's the instance you're referring to, Charles. So my first so I continue to invest both passively and actively, as you said. I'll always be both, hopefully, for a long time to come. It boosts your returns, all the reasons. But the first general partnership was the classic what not to do. So it was a property, 139 unit property in Beaumont, Texas. Now I'm in Houston, so it's about 100 miles east of Houston, for those of you who don't know the geography. It's a great community. It's a blue collar community, so great for B's and C's investing. They're heavily tied to the petrochemical industry, but not necessarily gasoline. 139 unit, flat roof, chiller boiler, built in 1965. And we bought it I think we closed in January of 18. And so, first of all, anxious to get started in space. And I remember I had a mentor, a buddy at the time, says, Randy, don't do a chiller boiler property. Just don't do it. They're so capital intensive. They're very efficient, actually, from a energy perspective, but they're just very capital intensive. And if something goes bad, all 139 units go out, not just one unit. And so large risk. So I hope you're in for a little bit of a long story, but we bought it in January of 18, and we decided to retain the property manager at the time because they had been involved with another local property we're at, and we thought they were rock stars. So we bought the property in January of 18, and we're all excited, full of energy, got a rehab budget all ready to go, raised about $1.5 million, $2 million, just gung-ho. And I think we closed January 15 of 2018, and it was approximately March 20th, March 15th of 2018. I get the call sitting in my office, Randy, I just want to let you know the building's on fire. Oh my gosh. Well, it wasn't the whole building. One of the buildings is on fire. So, so immediately you can just imagine how that's received 2 months into this. And they always say that, if you do this long enough, you're going to have a fire or a lawsuit. I just didn't think it was going to happen 2 months in. So, the lessons learned there, where there was a fire, thank goodness for property manager. The really good news is nobody was injured. There was no loss of life. Tenants did get out. Local fire department was on site, and you can imagine a 1965 building goes up like kindling. Because it's nothing but frame. And so the lessons learned were the advantage of local on-site management, get the services, the community services involved, take a tenant focus, I guess is the bottom line. It's easy as the property owner to get real financially oriented, but as a human being and as an owner, you really want to take a tenant perspective. So American Red Cross comes out, helps stabilize the tenants, gets them situated for the immediacy. Some local vendors contributed to gift cards and stuff like that. It was only about 20 units that were affected out of the 139, but it was I think 10 of those units had to be literally gutted and reframed, the studs and everything, and the roof had to be taken off. So a fire comes in, and then we retained this property manager that we thought were rock stars, and quickly realized upon takeover that we had asked them to switch out the on-site, and they had hired an on-site literally weeks before the fire. And she was a very good individual, but she had commercial real estate in the industrial space, not multifamily. And that's okay too. She was a great individual, but she didn't have any backup from the home office. So in the ensuing months, I effectively became the regional manager, and I was spending probably 20 plus hours a week making rent rolls, adjustments, maintenance fixes, hiring people, assisting in that, rehab, inspectors, vendors, et cetera, on the fire. But it was essential on the behalf of our investors. And I felt really compelled to make sure the the investors were safe and secure. So we were first and foremost wanted to do that. And so that's in the fires in March. Fast forward in about October of 18, we replaced the management company entirely. We retained the on-site person, but Charles, the lessons learned there is really on-site property management and the property management company. Do your due diligence. We thought we did, but you really don't realize what a bad one is until you've had one. It was really much more work than we ever had to do in retrospect. So get to know property management before you make LOIs, before you make deal acquisitions, so that they can be part of the transition and help implement your business plan.
So you inherited that previous property management company. How did you find the new one? Was it done through a referral?
That is a tough one on the fly when you're in the midst of, draining the swamp or attempting to drain the swamp. And so the reality is just calling fellow syndicators, talking to the educational groups in Houston. Who were they? One of my partners was a commercial broker, so he had some recommendations, and it was just literally keep calling until you can get somebody. And we actually found a really good one. They were like, it was just night and day. It was just incredible, the difference, the assistance they could give from the regional and the corporate office in terms of rent rolls and process. So it became, after about early in 2019, it became pretty easy to provide the asset management. But I'll say when people ask what does an asset manager do as a syndicator, I would say we earned every cent of the asset management fee on that deal.
Yeah. That's very interesting. It's also interesting too. I remember the first time I got third-party management, 10 plus years ago on a small portfolio of properties, and they're like, "Oh, you guys signed like a 1-year contract with," and I found, my father actually found it through a referral, and now I go back and really you don't understand if they're going to be a good manager or not. And it really takes a year plus. So, I will never get another referral, or I'll never get any of these major vendors that aren't coming from referrals. Property manager being because you're going to get, as I found, some of the best, and from brokers are fantastic, and investors with similar properties in nearby areas are even better, right? And because you don't know. They start, oh yeah, we've rented all these apartments, we rent it. Well, just because you rent it to someone doesn't mean they're going to be a good tenant and all this kind of stuff going forward. And you don't know they're not going to be a good tenant for 9 months, 12 months in, right? Everybody starts off as a great tenant, right? And then some of them fizzle out when they're not vetted properly. So you don't really know exactly how good your property management is, I guess, and verify them until you have renewals coming up. People get renewed. They're not just getting, hey, we're not renewing you on this because you're a terrible tenant, and stuff like this. So it's interesting that with property manager, it's not like you just don't figure out right away if you're dealing with a good company or not.
Yeah, I echo that 100%. And we thought we had done the due diligence, asking the question, so are you an ABC property management company? What's your experience in this specific submarket? What kind of resources, tools do you have to offer? What kind of online or accounting tools do you use? And, do you use the accrual method, a cash accounting accrual versus the accrual method? And, subtle but big differences. How do you build community on a property? How do you try to create a sense of community? That's huge for tenant retention. And none of the big educators are teaching that stuff.
Yeah.
They're teaching acquiring and underwriting, and you get a $40,000, $50,000 a year on-site manager that is your arms and legs of a multi-million-dollar asset. So,
yeah, that's definitely, they're talking about raising money and finding deals, which is very important. But the asset management and property management really makes the deal. And if you're paying $40,000 for a handyman and $40,000 for the admin person right in the office that's doing leasing and collecting money, if it runs like that, these are the people that are actually the face of the property, and they have to be very good. And it's something that you can't overlook that, especially with larger properties where you have on-site management. You know what I mean? And because it's very important for every day they're going to see, every day your people in the office are going to, or your tenants are going to see these people as they're walking through the parking lot or through the hallways or whatever. So.
Yeah, they're the first impression they give. The sign may attract somebody out front, but the leasing agent and the property manager sitting in the office are the the old adage, you never get a second chance to make a first impression.
So let's talk about how you manage your passive investors during this. I imagine that was as much headache as the 20 hours or a big chunk of the 20 hours a week you were spending becoming a general contractor overnight.
Yeah, I said I got my honorary PhD degree in property management with that asset, but it was, like I said, looking backwards, it was very beneficial. I think what we tried to do was make it very personal. So, I got the call. I said in my office, the partners had a meeting that night, and we all got on the phone the very next morning with our investors and started to, not send out an email blast, but trying to catch them and talk through it to let them know. I didn't leave any voice messages other than call me. I want to give you a quick update. And so tried to make it very personal, I guess, so that they knew we took this very seriously. We were on it. And then after the initial one was just continued update and the monthly updates. So we would provide itemization in the letter itself of the spend. So here's what it's going to take to refurbish this building. Here's the estimated insurance proceeds, and just showing a breakdown of what's spent, what's to be spent, as well as concurrently, we were still doing the initial CapEx enhancements. So it became, obviously I think we ended up putting almost $2 million in this property at the time. But so communicate, and you can't over communicate is all I'm saying. You can't give too much data. In my mind, the tendency for some syndicators is just to give the executive summary, the 3 or 4 bullet points, rehab's on target, blah, blah, blah. Yeah. I would just encourage more detail than less in those environments. And yes, it was time consuming, but I think we built a lot of rapport and with investors and trust. Obviously, too, managing expectations. When that happens, distributions are going to be we discontinued distributions for the immediate future to preserve cash. So we hadn't, 2 months in, we hadn't even started distributions, but we also telegraphed to them that distributions were scheduled to come in at 6 months. They were going to be postponed. We actually made one in 9 months and 12 months, but we missed year 1 targets, but we had that communication along the way that I think they were expecting it. So the good news, I got to give you the good news is we sold it 21 months in October of 19 for 120% return to investors. So we were ecstatic in the end.
Yeah, so your investors will return your calls for your next project, I guess. That's awesome. That's great to hear that you went through that whole process and you're able to come out and fare. I mean, what the amount of experience you received in 1 year that you probably didn't want to receive, but now has probably shaped how you're investing into the future. How has your operations changed over your portfolio going forward after this experience?
Well, I think I don't know if it's because I've done some passive and active or GP investing, but I think my criteria becomes more conservative. I think the market situation we're in, you want to make sure obviously that a property can cash flow immediately. You may preserve cash and not make a distribution for the first 6 months or so, but it's got to be producing cash right away. You have to expect some of those bad things to happen. Pro formas are always just pro formas. And coming from the corporate world, you realize that not a lot of investors do, but it's your track record. So we have a good track record on that one as we look for new ones. But I would say it's underwriting, it's looking for cash. And the other thing would be really to make sure we weren't undercapitalized, but we should have asked and raised more money coming in than we did to have more of a cushion. So that would be another key element going forward. And the other one, Charles, back to the property management one. I won't even write an LOI today unless I've got a property management company in that submarket that I know and have talked to and have a relationship with.
Yeah. Yeah, that's very, very important. I think anybody that's not planning on active managing should have that portion of their team set up and vet it before they go. And just like you're going to have an attorney, your real estate attorney set up, and your lender and all those things that you should have in line before you're putting out LOIs, definitely the property manager, because it is, I feel, the most important piece of the whole investing puzzle, because like you said, they're your ears and your eyes of the property, but they're also the face of the property for your tenants, which is super, super important.
And well put. And you don't get that until after you've done it once.
Yeah, for sure. Or you get a bad one, right?
Yeah.
So you're a coach for new investors. What mistakes, Randy, do you commonly see new investors or seasoned real estate investors make?
Yeah, so I guess you indicated, so I started out at one of the large multifamily groups here in Houston, and then transitioned to one in Dallas. And I've joined recently Rod Khleif's organization as a part of his mastermind, but also I'm a coach because I really love to give back. I really like, maybe it's just because of my season of life I'm in, I help many people have built into my journey along the way. And so I really want to give back. May sound corny, but it's true. And I've had several students. So the answer to the question is, what's the kind of mistakes do I see? I think understanding your why. I sense that a lot of people I come in with the idea of get rich quick scheme. What's the 12-step process to have $1 million portfolio in 6 weeks or 6 months or whatever? And that may be a little exaggerated, but so it's the get rich quick scheme, not understanding the challenges and the time commitment. It can be done. It's very, as someone told me, this real estate really isn't, brain surgery. It's just executing what's been done hundreds of times by thousands of times by many other people. And if you study their models, so I really enjoy talking to them, and you get them all over the board. I think the other one is understanding your personality. So the illustration I draw is, I don't know if you've ever heard the ready, aim, fire illustration, right? So I'm a ready, aim, fire individual. Learn the process, analyze it, implement it. And there's a lot of people that come into it just, they want to fire, aim, ready. I had one student was in Seattle, and he was literally we'd had one discussion, and he was going to become a GP at a property in Houston, like an 80-unit property. And I said, have you been here? Talk to the guy. Ended up, this was I don't know if there was a class F property status, but since I was local, I just did online looking. But it was a class F, or I don't know what's after that, G, but it was it was in the hood. So educate yourself. The encouragement I give to students is back to that illustration of define your strategy, study the different strategies, and it's a marathon. It's not a sprint. Stay in it for the long haul. Don't get discouraged, and look for the singles and the doubles, and you do that over a long period of time. That's better than the person who hits home runs infrequently and strikes out as many times.
Yeah, no, I definitely agree. The other thing too is that you were saying about peel and analysis paralysis. And I think I've had that before, even after starting to invest into multifamily and commercial properties. And I came to the realization years ago where it's like, because you had some really good, home run properties. You're like, oh, that was a home run deal. We did fantastically well. And then you go through and you're like, well, not everyone's going to be like that. I'm going to have some doubles, some triples, some home runs, because you don't know where you are in the market cycle. You don't know how you're acquiring, the deal, sourcing the deal from people. And so that's a huge thing too, is that it doesn't have to be a grand slam.
Right.
Every deal you're doing, just make sure it's a good, like you said, a conservative deal. You've checked off a lot of boxes for it being that cash flowing from day one, all these important things, especially when you're having investor money, which, you really shouldn't be doing a deal with investor money until you've really done some yourself. So you kind of have an idea of what you're doing before you take people's money for something that you've never, you've never proven yourself. You know what I mean? You no proof of concept. But
I think
what
you
do
said
you?
it very well.
Yeah, thank you. What do you think are some of the main factors that have contributed to your success, Randy?
One is I am a lifelong student, so I go back to that education. I started investing passively before I ever became a general partner because I wanted to. I didn't have full-time status in this. I still continue to work, as we said. So a lifelong student, I wanted to learn it. So I started investing passively. I joined the educational groups. I think many people push back, well, I don't have tons of money, whatever, but I think back to the amount of money I invested in my undergraduate and graduate degrees, and with little or no expectations for doing that. But so education, people need to educate themselves. And I think that's huge, is back to what we just said, it's, the hare and the tortoise, slow and steady wins the race. So just look at it as a marathon, be a student. There's so many opportunities out there. I've been doing multifamily for 6 years now, and there's so many opportunities now to network, podcast, local meetups, the national and the regional educational groups. Hang in those spots and you'll get a ton of free education. And you're hanging around with like-minded people who want to do the same stuff. So I would say education, desire to learn, taking the long view versus the short view. These couple the
nice. Fantastic. The other thing too is that when you were saying about all the networking, I agree with that, where I'll go to a networking event for 2 or 3 days, and my thinking going into it is meeting one person or getting one kind of nugget of information. And I can look back on a number of conferences I've spent, and you just get one thing that you hear from someone else, maybe just in a one-on-one meeting in a hallway outside of it, or afterwards at dinner, or whatever it might be. And you take that and you implement to your business, and it's worth everything, that all the time you spent and all the money you spent and everything like that. So you don't know who's going to give it to you. You don't know where you're going to get it. So definitely.
And they'll come where you least expect it.
Yeah, for sure.
And as you start to attract investors, I do, and you have conversations, luncheons, Zoom appointments, whatever, it's just fascinating. And that I love that aspect of it too, as well as the analysis.
Yeah. So how can people learn more about you and your business, Randy?
Well, Charles, I think it's the easiest thing is just go to my website. It's invest-ark.com, invest-ark.com. There's a investor tab there that you can schedule an appointment. Would love to talk with you if I can provide any value on anything today or otherwise, but it's just a privilege to be here.
Well, thank you so much, Randy. I'll put all those links into the show notes, and looking forward to meeting up with you again here, connecting in the near future.
Thanks so much. Have a great day.
You too. Bye-bye.
Hi guys, it's Charles from the Global Investors Podcast. I hope you enjoyed the show. If you're interested in getting involved with real estate, but you don't know where to begin, set up a free 30-minute strategy call with me at schedulecharles.com. That's schedulecharles.com. Thank you.
Thank you for listening to the Global Investor Podcast. If you like the show, be sure to subscribe on iTunes or Google Play to get new weekly episodes. For more resources and to receive our newsletter, please visit globalinvestorpodcast.com. And don't forget to join us next week for another episode.
Nothing in this episode should be considered specific, personal, or professional advice. Any investment opportunities mentioned on this podcast are limited to accredited investors. Any investments will only be made with proper disclosure, subscription documentation, and are subject to all applicable laws. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Syndication Superstars Incorporated exclusively.